Hi everyone, nice to see you again. Today, we will dive deeper into several basic concepts mentioned in our previous video. First, Toyota's approach to explaining the profit and cost structure differs slightly from traditional business approaches. The traditional perception of profit and cost structure is that the price is decided by the cost incurred and the profit you are going to earn. However, in lean thinking, profit is what's left of the price after deducting the cost. This means that if the price is certain, the profit that you can earn will be determined by the cost incurred in the process. We explained in the last video that this is why Toyota cuts costs to maintain a competitive price while retaining the same profit. However, even if it is just for a certain amount of profit, cutting costs is more effective than increasing prices. Let's test both ideas to see the difference. Assume that an organization has a cost of $90 and a price of $100 for a product which can make a margin of $10 for each product sold. In this case, organizations have two options to increase the margin: raising the price by $10 or reducing the cost by $10. As a result, the organization can increase the margin by around 18% in the first scenario, but in the late one, the margin ratio will be 20%. Although both options result in the same change in monetary terms, their impacts on margin percentage differ. A 2% margin doesn't sound significant, but never underestimate it, plus the asset turnover. The small number could add up to a huge amount of money over months. That is the reason why the lean methodology prioritizes cost down over scale up. Furthermore, while costs are typically under organizational control, allowing flexibility in optimizing strategies and resources, prices are often influenced by external factors and various market forces beyond direct manipulation. So, I'm going to show you where those costs hide based on a tree diagram that resembles a return on equity tree. At the root of the tree lies the profitability organizations pursue. The first layer is cost, and working capital, and sales relevant in finance. The second layer is business elements being cascaded down from the first, focusing on financial aspects. The last layer links branches to lower-level operational KPIs, aiding plant workforce understanding of the association between business performance and operational decisions. The costs in an organization exist but are not limited to those elements. The tree map also gives you a clear roadmap of where you would be focusing on to reduce costs. However, it doesn't prioritize what activities you should improve for cost down and how. So, let's go back to the 5 principles to see if we can find any hint to solve this problem. As we know, the first principle of lean is the value of the process or products the customer is willing to pay for. Based on that, the values analysis of a process enables you to differentiate non-value-added activities from value-added ones. The activities in a process can be categorized into 2 types, value-added and non-value-added, according to the definition of value analysis. If the activities are value-added, you have to make it flow as smoothly as possible. Does that sound familiar? Yes, if you watch the previous video, this statement will remind you of the third principle of lean, flow. On the other hand, the non-value-added activities need to be grouped again in terms of whether they are necessary or not. When it comes to necessity, it hinges on whether the activities are indispensable to a process that generates a product or service the customer is willing to buy. After we find out and categorize the NVA activities, we should eliminate any unnecessary NVA activities while reducing the necessary NVA activities. Let me provide some examples to illustrate the definition. Is a visual inspection process non-value-added or value-added? Give yourself a couple of seconds to think about it. What was your answer? In this case, a visual inspection process is considered non-value-added because it does not alter the product's properties or characteristics. Another example is that image you are in a fridge factory, seeing a long overhead production line with the fridge doors hanging on and being moved from a painting workshop to a final assembly line. Do you think the whole transit is value-added? Same, 3 seconds for you to figure it out. It is non-value-added. For the same reason, just being moved from one place to another doesn't change the character of the doors. I believe that if the customers do have a choice, they won't have to pay for the operations that cost a huge amount of money to set the machine up and maintain them. Other than that, the 7 wastes, as mentioned earlier, can serve as guidelines for identifying non-value-added activities aligning with one or more of these waste categories. Expanding on waste identification, we can employ the ECRS approach to systematically reduce or remove wasteful steps from manufacturing or transaction processes. ECRS stands for Eliminate, Combine, Rearrange, and Simplify. It is a very straightforward approach that explains itself by its name, literally. We can try it out in our minds by using the previous example. We don't have to wait until the painting is dried out before hanging them on the overhead production line. Instead, we can hang them on the line right after the doors are painted and let them dry while they are being moved. By combining the process of transporting and drying, the waste in waiting and transport can be reduced. There will be more examples and practices that you can find in your workplace. That is all for today. Thanks for watching today's video, and see you next time.